Can you imagine the majority of your portfolio, and you may not have looked at this in a while, but the majority of the portfolio returns come from a very specific sector and then everything else is negative? That can be frustrating, not only as an investor, but as an advisor. And then it takes the patience to say, I'm going to wait for it to rotate. I'm going to wait for it to broaden. Hey, this is Darryl Lyons, CEO and co-founder of Pax Financial Group, and you're listening to Pivot with Darryl Lyons. This information is general nature only. It's not intended to provide specific investment, tax, or legal advice. Visit paxfinancialgroup.com for more information. Now, I believe that better money decisions happen in conversation, and so I'm hoping that this can be the beginning of a conversation with you and your advisor or somebody you trust to help you make better money decisions long-term. Money decisions are just really peculiar. A lot of times this show will unpack behavioral finance as kind of a common theme because the majority of our net worth is a byproduct of the decisions that we made from our youth or from yesterday. So I have a pondering with Pax question that came from social media. Should I buy precious metals? Precious metals are a peculiar investment to own because most of the time people buy them when they're hot. And when that happens, it's too late. And I've seen plenty of research on this, that the majority of people end up losing money on precious metals because they get in at the wrong time. So here's my contention with precious metals. It's hard to know what specific precious metals to own or how to own it. Some people, if I think about gold, do you want to own coins or bars, or do you want to just own the exchange traded fund? That just depends. So it just depends certainly on why you would own precious metals. If you think the world's going to collapse and you want to own bars and you think that would trade easier than maybe guns, ammunition, and alcohol in an apocalypse, then that's on you. I don't think gold will trade as well in an apocalypse as guns, alcohol, or other things, but that could be your purpose. So know your purpose is my main point. And if your purpose is I just want to have exposure to this specific type of investment, then exchange traded funds could be the way to do that. Just don't buy it when it's hot and make it a part of your investment portfolio, not a big chunk of it. And be committed over different market cycles because there's going to be times where it's going to look horrible and sometimes it's going to be okay. So I'm not terribly opposed to precious metals. I just think you just have to make sure you align it with your purpose, know your purpose, and put it in context. Make sure you don't have too much. So I hope that helps you. Okay, so it actually leads to today's show, which I want to talk about two words, namely, I want to talk about rotation and broadening, or maybe the word is breadth. It's kind of probably the same root word there. But rotation is important because oftentimes in the stock market, you may not hear it. Maybe I just nerd out on this, and I hear it every day. It seems like there's a rotation happening. There's always a rotation happening from the winners of yesterday's stock market run to what may have been yesterday's losers. So a rotation is namely a discussion about how the leaders, namely the Magnificent Seven, the NVIDIA and the Facebooks, how they've been leading the economy. They've been providing most of the gains in your portfolios over the last several years, and that there's beginning to be a rotation from those winners over to some of the other names. There were several years where the vast majority, so typically a stock market conversation is built around the S&P 500, the 500 largest companies in the world. And what we've seen in several years past is that 7 of those 500 companies were doing really well and 493 were just like meh. Well, there's a rotation from those 7 companies, and maybe even broader than that, there's a rotation into other areas, namely sectors. So when you hear the word rotation, it means it's moving. There's a rotation from those yesterday's winners into other areas like maybe consumer discretionary or healthcare or energy, which is good for the economy. It's just good for society in a whole. I mean, that leads me to the second word, which I will get back to rotation. I don't want to leave that thought unfinished, but it does lead me to the second word of broadening out. The broadening out is very healthy. I don't think we really want a concentration of the majority of our returns and our investments out of 7 companies. I think that presents a lot of risk to all of us, not only as investors, but as consumers and participants in this overall capital markets. It's like going to a potluck and you show up and only one family, maybe that's you, that brought food and nobody else did. That's just not healthy. Or maybe even the Spurs, I use the Spurs a lot as an analogy. Maybe all the the blocks and the points and everything's happening with Victor Wembanyama and not any of the other players. And so that can, make you a little nervous too, because it just takes one injury or one strategy to cause that to be disrupted. So broadening out, a rotation is an event that takes place where people are rotating from these concentrated technology positions that have really done well into other parts of the economy. And then it's broadening out. They use the word breadth a lot. It's broadening out to other areas. And so this is a really healthy thing for the economy in at large. We want to see this. What triggers this oftentimes? Well, I think some of the triggering now that's taking place is many investors are asking, when am I going to see my money on AI? Because a lot of investments have gone into data centers, which I know that you have some comments on data centers. We can get to that another time. But the money has gone into data centers, and they call that CapEx, capital expenditures. And so a lot of investors are saying, I don't know with confidence that I'm going to get a return on those investments that you've been making, which has been, I don't know, tens of billions a quarter. And so investors are saying, I don't know when I'm going to get my money back. So I'm going to start looking into other areas of the economy where I can get money back faster or get some positive cash flow. And so that's part of the decision making. The other part of the decision making to broaden out, to rotate into other areas, is valuations. There's some stuff that's been on sale, and so the market starts to say, healthcare seems to be attractive right now, or energy, or consumer staples, or consumer discretionary. There's all these sectors, and the market's saying those stocks that I've owned that have done really well, I still like them, but the price of them, it's just not near as attractive as it used to be, and some of these other stocks are on sale. This is what makes the economy work really well, by the way. And this is also the reason smart people lose a lot of money in the stock market, because they tend to chase the winners. They tend to concentrate their portfolios. They don't diversify. They tend to think that they have some inside game. And then the market makes everyone look stupid because it rotates, and it does rotate. It's done this over the years and creates this breadth that you just didn't expect, and you didn't expect the timing of it. And so I know some people here that have lost some serious money because they have made concentrated bets, and those didn't materialize because the market rotated at the time that they didn't expect. And while you as an investor are sitting there going, I just don't mess with it. And frankly, even though to me and maybe others, it feels like it's lazy or intellectually dishonest, it's actually the right thing to do. You spread it out, you diversify, so that way when one sector's out of favor, you just hang on to it, and then eventually it rotates back and gets back into favor. And the market tends to do that. It has historically done that. And so that I really credit those people who have patience and diversify, as much as, it may feel as though it's intellectually dishonest, as much as it may feel that it's lazy. Evidence has shown that that's really rewarded people long term. It's just sometimes it takes some patience. I always say, as a financial advisor, diversification means that I'm always apologizing for something. Diversification means I'm always apologizing for something, because something in there is just out of favor. But keeping it in there means that eventually a rotation or a broadening will take place, and then that same thing that I was apologizing for will be tomorrow's winner, and that's usually how it happens. That's in sectors. Oftentimes this broadening happens from a global perspective, meaning that the international markets may be out of favor for a period of time, and we've seen this prior to 2 years ago. There was a long run where international markets were really out of favor. We're seeing a broadening out as well in the return profiles of your investments, where the international markets are in much more favorable condition. We're enjoying seeing some of that broadening out. That happens with currencies. We've seen the Japanese yen go down. I didn't want to say fall, but you could say fall. And that creates some conditions for people to start looking at other places in the markets and buying things that are on sale. So broadening and rotations happen both with sectors in the United States, and actually it also happens internationally. So people start looking outside the United States for things that might be on sale. Then it also happens in what we call asset classes. So I've mentioned two different investment styles so far, or I guess distinguishing characteristics of investments. I mentioned the sectors, which have distinguishing characteristics, and the international markets, but there's also the the size factor that people consider. And so there's been certainly a rotation there and a broadening out there. There was a lot of concentration, again, in this magnificent seven, these seven companies, the technology space, the AI space, a lot of concentration there, and everyone's intentions there. And so over here in the horizon is a little kid called small cap stocks. And those are smaller companies, and those have seen favor again. So people have started to say, I think that there's opportunity to buy there because the prices are cheaper than the ones that are in the tech sector. And what happens ultimately is it gets something called momentum, and that momentum starts to build. And so that's why we've seen some of these other size of investment, let me say it this way, other size companies represented as an asset class start to really excel, small cap being the one in particular. And small cap's a funny one because I got to tell you, I might have done a podcast on this. I didn't have a lot of conviction. I'm not sure I still have a lot of conviction in the small cap space because it's changed quite a bit. The private equity market's changed the small cap sector. But the reality is that it still exists. And if something is on sale as an investment opportunity, the market will eventually determine if it's worth it. And how do they determine if it's worth it? And this is, I think, ties into some of today's rhetoric, is they usually determine if it's worth it if it has free cash flow. If there's cash flow, if there's promise of cash flow, certainly. But right now, a lot of the rotation has occurred because the Magnificent Seven, those big companies, they have a lot of what, again, called CapEx, capital expenditures in large data centers. So there's not a lot of free cash flow that's right in front of you. So they're looking at other opportunities in the marketplaces that do have free cash flow, that do have earnings, that are exceeding earnings expectations. And so the rotation has been somewhat of a collective thought process of, hey, we need to start having positive cash flow investments in our portfolios. And so small caps present that opportunity in some cases, but also the other factor that they consider when they rotate out of these big names is the price. There's just, they just can't pass up the price. And those prices are usually represented by, historically we call price to earnings ratios, and they're a very important way to measure whether a company is on sale or not. There's a number of different measurements, but that's the big one. And so the rotation from the tech sector, from the Magnificent Seven, has been happening in different iterations over the last several years. And that rotation and the broadening is taking place from a sector level, which is good for all of our lives, frankly. We want to see other areas of the economy, not just the tech sector, do well. We want to see the energy sector. You may be employed in the energy sector, or you may know somebody. We want the healthcare sector to thrive. So we want this money flow and this ecosystem to not just stay concentrated in Silicon Valley. We want it to rotate out. So that I'm just expressing not only just from an investment perspective, but from a society perspective. It's just healthier to go to potluck where everyone's bringing something and everyone's participating. And so this rotation from tech to the broader sectors is just healthy, and we're seeing that. And I say it's happening in different iterations because it does ebb and flow. I see money kind of go from the tech, and it goes weekly. Like weekly, the tech sector is favorable, and next week it's not. So, but overall, there is a broadening out, and that's healthy. And then that broadening out, taking it to one degree further, is also playing out in the international markets, which is healthy for a lot of us, because a lot of us, if you look, you've got about 20% international. So having some of that international participate in your growth is really healthy. And then finally, it's also broadening out to the size factor of your portfolio. So small cap, mid cap, large cap. It has historically, over the last several years, been really, really big. The return profiles have been namely in the very hyper scaling, large mega cap names, and now it's rotating out, broadening out to some of the smaller mid cap names, which is really healthy for all of our portfolios. Again, when it comes to investing, diversification works. I believe in it, despite it not being that sexy. It works. The problem is you're always apologizing for something, and the market is now starting to behave in such a way where you're not apologizing as much. Can you imagine the majority of your portfolio, and you may not have looked at this in a while, but the majority of the portfolio returns come from a very specific sector, and then everything else is negative? That can be frustrating, not only as an investor, but as an advisor. And then it takes the patience to say, I'm going to wait for it to rotate. I'm going to wait for it to broaden. And you wait and wait and wait. And here's what happens to a lot of people. And I'm just warning you right now, their patience runs out. They shift it. They say, I'm done waiting. I'm tired of seeing all these poor returns, and all my positive returns are in these concentrated areas. Then they decide to self-select out of all of those, what they consider air quotes, underperforming investments, into chasing the winners. And then it rotates on them, and it makes smart people look so stupid all the time. I've seen that so many years now. And so my contention to you is knowing that rotation and broadening out is a part of the economic cycles that's happened in our capital markets for a long time. If you know that that's kind of a part of it, just be patient. The market has, this is another important quote for you to know, the market has a long track record of transferring money from the impatient to the patient. And so if you're patient, knowing that there's cycles of broadening out and rotation, I can't promise you anything, of course, but it historically has benefited those that have stayed diversified and stayed the course. Hope that helps today. Those are the two words of the day, the broadening or breadth and a rotation. Hope you understand a little bit better now. And as always, you think different when you think long-term. Have a great day.